Thanks for joining us for another episode of Boom and Bust. I'm your host, Tony Clement. I'm here live at the News Forum, where all voices matter. Well, the misery index has returned. Back in the 1970s, it was a measure of inflation plus unemployment, and it is now relevant again. Here to discuss is the Fraser Institute's Executive Vice President, Jason Clemens. Welcome to the program, Jason.
Thank you. My pleasure.
I guess first, tell us about the origins of the misery index.
Sure. It's by a famous economist, Arthur Oken. He was really trying to capture in a single measure two different phenomenon that at that time theoretically were not supposed to be happening at the same time, which is high rates of inflation. So that is high rates in the increases in the price of goods and services that consumers are buying each year, at the same time that you also had high rates of unemployment. And so what he simply did is combine the two measures and then call it the misery index. And unfortunately, it was front page news for the better part of a decade, as many Western countries, the United States, certainly Canada, grappled with the problem of having both high inflation and high unemployment. And for viewers who are old enough, they will remember, unfortunately, the 1980s when interest rates were incredibly high, almost unimaginable now, at the same time that we had fairly high unemployment rates, as the central banks at the time were trying to get a hold of inflation. So part of what's going on right now is the renewed worries about inflation emerging again as a potential and real problem.
Yeah.
Sorry, go ahead.
Yeah, no, I'm going to get to that in just one second, but I just want to unpack this just a little bit more. So the economic theory would imply that high inflation rate actually means that the unemployment rate is going to go down because there's greater people want, are looking for deals. Or give us the economic theory behind high inflation, low unemployment, low inflation, high unemployment.
Sure. So the basic idea is that as you get higher rates of inflation, particularly inflation that is not expected, and that's a really important part, particularly given today, it's about people's expectations.
Right.
And so what the theory was telling us was, if you're getting higher inflation than is expected, you're actually getting a reduction in real wages for workers, which would mean the demand for those workers should be increasing. And so the idea that you could have high rates of inflation that would be eroding the real cost of employee compensation, but you also had high unemployment at the exact same time, and that it was sustained over time, was just something that most economists in the mainstream at the time didn't think was possible. Now, there's a pretty famous Nobel laureate who predicted all of this. But at the time, in fact, something pretty famous in economics known as the Phillips curve was telling us that you couldn't have both at the same time, particularly sustained over time.
Right. Supply and demand curves on the same chart, and yet here we are again. We've got about a minute before the first break. So again, Canada in the 70s and the 80s, we saw this similar phenomenon. Is that right?
Absolutely. Canada, the United States, Western Europe, even parts of Asia, we were all suffering from, as President Jimmy Carter called it, the malaise, which is, I would say, a pretty anemic economy. I mean, when you've got high inflation, that's eroding the real wages, the real income of households, and at the same time, you've got high unemployment. So even if you are employed, the value of the earnings that you're getting is going down over time. And you have a significant amount of people who are unemployed. In other words, they're actively looking for jobs and they can't secure them, which, again, for your viewers who are old enough, the 1980s may have had great music, but it certainly was not a great economy for many workers, particularly in the early 1980s, when, again, interest rates were raised to a level that I just don't think most people, unless they lived through it, can even imagine today.
I remember paying 16% on my first mortgage. So yes, you're absolutely right about that. We're going to return with Jason Clemens after the break, continue this discussion. So please stay with us. Welcome back to Boom and Bust. I'm your host, Tony Clement, here with Jason Clemens. He's the Executive Vice President of the Fraser Institute, talking about the misery index. Jason, we were just getting into what the situation now is. So this misery index came about in the 70s and 80s. You're seeing a return of a similar situation now. So let's unpack that a little bit. What do you see happening now? And secondly, how long is this likely to last?
Sure. So about 6 months ago, we started to see more stories using the actual term, the misery index, which frankly, really, we've had probably 20, 25 years of nothing talking about the misery index, or very little, because we had both low and stable inflation and at least lower, and in many countries, including Canada, declining trend in unemployment. So the combination of the two just was not a front burner issue like it was in the 70s and early 80s. Unfortunately, as I say, in about the last 6 months to a year, depending on which country you're looking at, inflation rates have clearly increased. We have some countries now that are approaching 10% annualized inflation. The latest numbers in the United States are there over 7% inflation. The latest numbers for Canada are almost 5% year over year inflation. Now, that's compared to a stable rate of under 2%. So again, Canadians for better part of 2 decades have been enjoying low, stable inflation. So to now be up at 4.5% to 5% is just not normal for most Canadians. In fact, as we've talked about, very few Canadians probably remember the 70s and the 80s. The other thing, though, that is really important and is one of the major risks is people's expectations changing.
Right.
And so with respect to your second question about how long could this last, it will last longer if people's expectations are changing, which I think there's some evidence they are, that instead of expecting stable, low inflation below 2%, they now expect 4%. Because what that means is when they go to negotiate wages, they are going to be demanding larger increases in their wages. And the core problem with inflation is you have too many dollars chasing too few goods and services. And so just increasing wages without increasing the productive capacity of the economy to produce goods and services is not going to resolve the problem. It's going to make it worse. And so I think, thankfully, the Bank of Canada is very sensitive to this issue about expectations. I think the Bank of Canada has already made some moves. Certainly, I think they're ahead of some other central banks in Western modern countries. But this idea of our expectations for inflation in the future is critically important.
Yeah, and of course, if there's increased wage demands, sometimes companies can't afford that, and so they let more people go. So not only advances inflation, but it advances unemployment, right?
That or they can increase the price of goods and services, which again, you just get this deleterious cycle, so to speak, where, and again, this is exactly, if you look back into the 70s and 80s, this is what happened, right? That people were expecting 4% inflation. They started demanding 4% or 5% wage increases. The price of goods and services were actually increasing at 6%. And it just started feeding on itself. And this, I think, is part and parcel about why so many economists and thankfully central bankers are quite worried about tempering expectations that we are going to get back to a low, stable rate of inflation, rather than allowing these expectations to start building momentum for higher rates.
So how does that factor in? The Bank of Canada recently kept its interest rate stable at its current rate, rather than increasing that rate, signaling to the economy that interest rates were going to go up. So how does that fit into what you're talking about?
Right. So I think there's a couple of things going on with the bank. So the first is it has almost eliminated its holding of government short-term debt. So in other words, the Bank of Canada normally holds some short-term debt and longer-term debt of the federal government. During the crisis, it increased substantially its holding of debt across the board, not only for the federal government, but also for some of the provinces. It has, over the last 4 months or so, basically tapered off all of the short-term holdings. Now, unfortunately, it's still holding a considerable amount of long-term debt. So just as a metric for your viewers to understand, pre-pandemic, the Bank of Canada was holding about $36 billion in federal long-term debt. The December numbers are showing it's holding about $460 billion.
Okay, it's an important topic. We'll come right back to it. Please stay with us. Jason, I had to cut you off there, but very important point about Bank of Canada rates. Please continue with your thoughts on it.
Sure. So as I was saying, the bank has basically curtailed its holdings of short-term government debt. Unfortunately, it's still holding a considerable amount of long-term debt, but it has signaled that that will also be tapered off, meaning that the federal government will have to go to the market to get and finance its new borrowing, which imposes a discipline on the federal government in that it has to pay a market rate of interest rather than what the Bank of Canada is willing to finance it at. In addition, the bank has clearly signaled its commitment to get back to the 2% ceiling for inflation. So the bank has a goal of having stable, low inflation below 2%. It has signaled its commitment to that. Its new mandate from the federal government reinforces that, although frankly, I think it was a little watered down than the previous mandate. But it did nonetheless signal to the market its commitment to get back to that band. I think many observers would have preferred the bank to move on interest rates. Again, to not only talk about the need for higher interest rates and a curtailment of the bank financing government debt, but actually moving on interest rates. So I think now we're in a situation where the bank really cannot afford to pass in March.
Right. Yeah.
The bank is going to have to move on rates in March, and then continue to talk about its commitment and its willingness to increase rates further to get inflation under the 2%. And again, as we talked about previously, which is probably the most important thing, is to temper people's expectations about what inflation will be for the rest of the year and going into 2023.
Yeah, no, I agree with your analysis. I think that they set the table, and we'll be seeing some moves shortly as well. Getting back to the misery index, how does Canada compare to other industrialized nations?
Pretty miserably, unfortunately. If we look at the 2021 data assembled from by the IMF, the International Monetary Fund, there's 35 industrialized countries that are comparable. In terms of the unemployment rate, Canada is 8th. In terms of the inflation rate, we're 4th. So when you put them together in terms of the misery index, we're the 6th worst of the 35 industrialized countries, which again, I think is important for Canadians because oftentimes I think the federal government is being a little disingenuous when they say the inflation problem is a global problem, which it is. Yeah. But Canada is at the high end of the inflation rates we're observing. And so clearly we have a deeper problem than some of the other countries who are also experiencing inflation. And so I hope that the misery index illustrates that, yes, this is a global problem, but Canada, unfortunately, is on the wrong end of these 35 industrialized countries in terms of both our rate of unemployment and our rate of inflation.
Yeah, no, I see your point there. Federal government, do you have any prescriptions for them, given the high rate of the misery index?
I do. I don't know how interested they are in some of the recommendations. I think first and foremost, which unfortunately we have a lot of evidence that the current government is just not interested in balancing the budget, is just not interested in living within its means. But that I think would certainly help. Presenting a budget in the next couple months that says we are on a track in the next 3 years to balance the budget, which means we're going to prioritize our spending to live within the means in terms of the tax revenues that we expect to come in, which means, again, which is important, that they're going to stop going to the market to finance new debt in order to spend more money. I'm not holding my breath on that, given the experience since 2015 with the current federal government. I think secondly, which is important because the Minister of Finance just signaled this, although again, I'm a bit skeptical, measures in this budget that would improve economic growth, improve the incentives for workers, entrepreneurs, and business owners to produce goods and services and grow the economy would also certainly help. Because remember, at its core, inflation is about too many dollars chasing too few goods and services. So increasing the production of goods and services can help. Unfortunately, the history of the current government is every time they talk about improving economic growth, it's really more about policies of redistribution, which redistribution doesn't improve economic growth. It just takes certain money from particular groups and redistributes it to others. There's very little evidence at all that actually improves economic growth. And in fact, if you look pre-pandemic, Canada's economic growth was the weakest it's been in the last 3 decades.
Jason, we're going to have to take another brief break, but we'll be right back with you. Please stay with us, everyone. And welcome back to Boom and Bust. I'm your host, Tony Clement, here with the Fraser Institute's Executive Vice President, Jason Clemens. Jason, trying to get a handle on this misery index kind of overlaid with the COVID crisis and some of the knockdown effects of that, obviously one of them being the supply chain crisis. Can you sort of fit all the moving parts for us? If COVID is less of a factor, say a year from now, does that affect this? Or if this supply chain crisis continues, does that affect this? Give us your point of view on this.
Certainly. So I think it's a great question. I think there's some moving parts to the question. So the first is let's call them the natural interruptions in the supply chain, because we have to respond to COVID. As the problems with COVID dissipate, we would expect those problems to sort themselves out. I think the more important problem is the amount of government policy that is impeding recovery. Even though the evidence is overwhelming, it has no effect on COVID. So as an example, there was a recent paper by several professors, one in Sweden, one in Denmark, one in the United States, looking at the effect of lockdowns globally on COVID death rates. And their conclusion was, if you look at all the data, lockdowns had absolutely no effect on COVID deaths.
Yeah.
But at the same time, we have governments continuing to constrain particular aspects of the economy, imposing rules that make it more costly to do business, when the actual benefit of those policies is at the very least highly questionable. So I think the sooner we can learn the lessons from the last almost 2 years now, the easier it's going to be for us to improve supply chains and, again, improve the production of goods and services. The second part of that question, though, which is really important, is asking if we're getting the balance right between supporting Canadians who are in difficult circumstances, either because they themselves are sick or a member of their family is sick, versus a policy that is paying people not to work.
Right.
And it's been my view for a long time, even going back to CERB, that we just did not have very well targeted programs. And so when we look at some other countries who are doing much better than us, their programs tend to be much more targeted than, say, the United States or Canada, which, again, I think is part of the reason you're seeing the inflation rates in both of these countries and the unemployment rates in both of these countries, and quite frankly, the deficits in both countries.
Yeah, and of course, we've got a situation where this is going to continue. The federal government has earmarked $100 billion in stimulus, even as our growth rate, our GDP growth rate improves. So, and just to finish the thought, the parliamentary budget officer has said, we don't know where this money is going or whether there's value for money, this kind of thing. So it seems like we're still on this track, right?
No, absolutely. I mean, if you look at the last 2 throne speeches, for example, which are supposed to reflect the priorities of the government, the words entrepreneur and business owner are almost completely absent. In fact, in the last throne speech, the word debt and deficit didn't appear once. And entrepreneur was never used in its traditional sense. It was used with respect to a government program for entrepreneurs. And so if the government is actually committed to improving economic growth, it seems to me the first thing it has to do is look at its policy since 2015, and that economic growth has declined. There's just no measure of household income or GDP per capita, GDP in aggregate, that is comparable to the Harper, Chrétien, or even the Mulrooney years. Those rates, the rates of growth or economic growth, are all down relative to those previous periods. And so to me, there's a real question of whether this federal government is willing to say what we've been doing since 2015 hasn't worked, so we're going to take a different approach. I think, unfortunately, what we're going to see is they're going to tie more spending, more industrial activism to a promise of economic growth, despite the actual evidence since 2015.
Jason, that's all the time we have today, but I want to thank you for coming on the program. Very interesting discussion.
My pleasure. Thank you.
All the best. Very interesting discussion with Jason Clemens there, talking about the misery index and some of the policy failures that have led to both high inflation and high unemployment at the same time here in Canada. We're the 6th worst in the world on that front. Obviously, lots to cover in the future on this, but thanks for watching today.